In this video, we're going to talk about the Federal Reserve Bank and monetary policy. The Federal Reserve Bank is the central bank for the United States, and its primary objective is to conduct monetary policy. When conducting monetary policy, the Fed used the data from the different Federal Reserve districts across the country. There's 12 of them. Each one of them has their own bank president. And 5 of those bank presidents are on the Federal Open Market Committee. One of those presidents being the president of the New York Fed, and then the 4 other presidents rotate through as being on the Federal Open Market Committee. The other 4 presidents rotate through, but the New York Fed president is permanent. Additionally, there's the Board of Governors, and between the 7 members of the 7 Board of Governors and the 5 bank presidents, that makes up the Federal Open Market Committee. The goals of the Fed are based on their what's called this dual mandate. The first part of the dual mandate is price level stability. We want prices to be relatively expected, or future prices to be relatively expected. So we want to have an idea of how much prices are going to inflate. It's because of the problems associated with unanticipated inflation. We've talked about in the past how when inflation is unanticipated, it redistributes wealth between lenders and borrowers, and redistributes wealth between employers and employees. So stable prices help to ensure that that redistribution of wealth is mitigated. Additionally, the Fed wants to maximize employment, or wants to have as many people working as possible in order to maximize production. So there's these kind of counterbalancing objectives that the Fed has to take into consideration when implementing monetary policy. The 3 main activities that the Fed engages in is regulation of banks, monitoring transfers between banks, and lastly, kind of conducting monetary policy through controlling bank reserves, meaning making more or less money available by banks for loans, with the goal being that during a recessionary time, the Fed will make more money available in order to stimulate lending, in order to stimulate spending and investment. And during expansionary times, the Fed's going to make less reserves available in order to prepare for future recessions where they may have to lower the federal funds rate or make more reserves more available. We'll talk about the relationship between banks' reserves and the federal funds rate in a second here. So the reason the Fed can influence interest rates by manipulating the amount of reserves available that banks have for loans is because banks need reserves available, reserves being the money that's deposits that are stored either in the bank's vaults or at the Fed, the money that's deposits that banks save at the Fed. It's kind of like you would save your money at a bank. Well, the banks save their money at the Fed, and they save them in the form of reserves. So when banks need reserves, they need reserves in order to provide liquidity, in order for these reserves or money to be available to offer as loans, because that's how banks make their money. This idea of liquidity is essentially assets that are immediately available for transactions. such as in the bank's case, offering a loan.